Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending July 1st, 2022. I'm Preston Brent. Thanks for tuning in. Well, for most of our U.S. members, this is a long holiday weekend with July the 4th, our Independence Day falling on Monday. So next week will be a holiday shortened week as we really kick off the second half of the trading year of 2022. Our theme for this past week is micro versus macro, and I'll go through that in just 1 minute. So this session will be a relatively short one because it's a nice holiday week and I just need to take a little bit of time and chill out and go hang out on the beach. But either way, we've had a very interesting first half of the year. Why don't we just kind of go through some numbers, take a look at some of these things, and then what I want to do is just quickly review, as we always do, some economic data, some treasury data, and then we'll take a look quickly at the European markets, Asian markets, and then a couple of key charts that I want to show you guys that you should be focusing on. And another note, Sunday, obviously for our members, our weekly market watch, we will not have because we will be off. And then next week I will be traveling. For our members, so our pre-market trader on Wednesday, I will be off, just taking these 4 trading days next week off as we kick off the second half of the year. So let's get into it and just see where we're sitting right now. So if we look at this, let me just get a couple of things on the screen here. Let's take a look at the index performance for this past week, okay, as we rounded out the last week of the first half of the year. As you can see, indexes have finished lower 3 out of the past 4 weeks. And even though Friday was a strong move higher, or kind of rallied into the close on Friday, for the week, everybody was down in the red. Year to date, everybody's solidly and constant in the red. NASDAQ, Russell in bear market, S&P almost in a bear market, and year to date, Dow down solid, just slightly under 15%, okay? Now, if we just look at the first half of the year, which actually closed officially this past Thursday, the S&P was in a bear market through the first half of the year, down 20.6%. That represents a loss from the June 4th highs of this year of over $9 trillion in equity value. So it will be felt, I can guarantee you. It's the worst start to the year for the S&P since 1970. Meanwhile, the Dow year to date, which again through this past Thursday's close, is down 15.3% for the Dow, and it's its worst start since 1962. And if we look at the NASDAQ and the Russell, NASDAQ was down 23.9%, Russell down 23, a little bit over 23%, both worst on record for each one of them. So there was really nowhere to hide in the first half of 2022, nowhere. The average bond fund fell over 10.7%, and that was the worst start for bonds and treasuries since 1975. Really, the only bright spot in the markets was energy, the strong commodities, really. But within the commodity group, energy was the best performer. Year-to-date gain through Thursday's close at 33.5%, okay? So really, if we look at the markets at a macro view, there's really only 2 certainties I see going forward. One, the Feds are going to increase the rates, okay? That's a given. And where I differ a little bit from some analysts is that I see the go-forward corporate profits coming down, not going up. And analysts are raising their earnings per share estimates through the second half of this year into 2023. I don't see that happening. But those are the 2 big areas there. But the one big one is corporate profits and what are analysts going to do. But what we've seen through the first half of the year raises a probability of a recession if we're not already in one over the next 12 months of 50%, okay? So looking at the markets here, you can see the PE ratio, the forward PE is down to 16.69%. I think it's still got further to go to the downside, which is going to take a little bit more off of the equity markets. Dividend yield at 1.71% for the S&P. 10-year Treasury actually closed 2.89%. Now, it wasn't higher from the prior week. It's actually lower. We were over, at one point, we almost hit a 3.5% 10-year Treasury yield, and it's been falling. And primarily because the Treasury market views the odds of slowing growth in a recession at a higher percentage. Clearly, growth in 2023 is coming down in the bond market, and the Treasury market's reflecting that with interest rates. We've already made big money shorting interest rates or going long interest rates, shorting bonds starting in Q4 of last year. So while the markets are down first half of the year in bear market territory across the board through Thursday's close, we're up over 20% in our tradable portfolios that we're running right now. So we've had a great year, and a lot of that doesn't even include energy. Okay. So we've been able to navigate these markets nicely. You can look at the sector performance. The best performer this past week was utilities at 4.12%. They love rates coming down. They just because it's a capital intensive type of industry. Energy is still the sector performance leader for the year. You can see the worst is discretionary across the boards. It fell over 4.7.5% this past week. Year to date is down over 31%. So really getting chopped up pretty bad. Okay. The other thing that why I'm believing that earnings will come down, the analysts, once they start doing that, that's going to drive the S&P down another 5 to 8%. Possibly even 10% from where we are right now. But much of the week's past economic data missed consensus expectations. We're seeing consumer confidence come in at levels we haven't seen in decades. We're seeing some manufacturing activity falling also. We're seeing the consumer purchases falling a little bit. First decline we've seen in 2022 over this past month. So the other thing that I saw that just kind of snuck in there towards the end of the year is the Atlanta Fed's GDP now model estimate. They're always missing it in a worst case scenario, but they came in at the first pass of Q2 GDP coming in down for the quarter of Q2 at minus 1%. Okay. If we do get that first pass in a minus number, that would pretty much assure we're already in a recession. Okay. So that's kind of some of the economic data that's floating up right now. We do get the Fed's preferred inflation gauge that came in at 4.7% for the past 12 months ending in May. Slightly below expectations, but that's the lowest level we've seen since November. But it does show that the economy is very sluggish. Economic data is very sluggish. So that's why the 10-year Treasury note came down, as you can see on the screen there, at about 2.89%. It's relatively low for where we've been, okay? Over at 3.5. Now, if we come over and we take a look at Europe real quick, and we look at the data, all of Europe is within the red for the week. The Euro stocks, FTSE, CAC 40, DAX, all in the red. You can see year to date not doing very well either. The ECB president, Christine Queen Bee Lagarde, I like to call her, reiterated her guidance for an increase of 25 basis points in rate hikes in September. And by the way, the Eurozone inflation accelerated again in the month of June. It came in at a record high of 8.6%, which matches ours here in the US, right? Of course, they're getting hurt even more so than we are by energy and food costs. They're just getting killed. But that's why a lot of analysts believe that Lagarde's going to be forced to hike the rates 50 basis points, but they're very conservative. So they're probably going to live with a higher amount of inflation longer than most. But their economy probably already is in a recession, or the odds favor them hitting a recession much before the US. Okay. So that's what we've got over in Europe. You can see it just really ugly. And then, of course, if we swing over and look at the Asian markets, you can see over there the Nikkei was down, but China and Hang Seng kind of in a bounce a little bit because they're opening their economy back up. They're kind of slowly opening back up. That's why we're seeing some green there. But year to date, everybody is in the red as far as index performance. You know, Chinese stocks, as I said, kind of moved up a little bit because their factory data month over month, year over year is getting a little bit stronger because they're now opening back up. So just understand the data is not as relevant right now as it should be. So we're seeing their PMI data come back up over 50, which shows expansion. The other thing that the People's Bank of China is doing, the PBOC, they're going to quote unquote employ structural policy tools, but the way we would interpret that mean is they're going to put more money in the economy. All right. So we're seeing there are only two banks and two countries that are putting stimulus into the economy rather than taking it out, and that would be Japan and China. Okay. Outside of that, every central bank on this planet is looking at raising rates to slow the hot economy down. And I've always said you cannot. In 2020, we shut down the US markets. In fact, we shut down all economic activity. And it wasn't just US, they did it pretty much worldwide. And people were locked up. Okay. The US, because we can print our own money, gave them most consumers an extra paycheck or two every week and every month. So consumer income actually went up in the U.S. But that's just going to flood our balance sheets. As you can tell, we've got over 8.8, almost 9 trillion on our balance sheet that we're starting to take down. There's going to be consequences for that. There's also going to be consequences for shutting down the economy. That was a big mistake that we never should have done to begin with. So anytime you create some kind of commotion in the markets, there's always a reaction to every action, always. And that's what we're going to be seeing here in 2022 going into 2023. There's a little bit of a lag time, but we're going to get that reaction. It's impossible not to. And you're seeing supply chains being clogged up longer than they should because you can't just turn the light switch off and then turn it on and everybody's hunky dory. I mean, just go to any airport and try and catch a flight out. You can't lay off pallets and then expect to bring them back on board and they start flying the next day. They can't do it. You got FAA restrictions. They got to be able to go through certification again, depending on how long they were out. And many of them were out more than 6 months. So that's going to take, 90 days to 120 days to get them back. Meanwhile, airlines are paying them a lot more in bonuses just to bring them back. What that does is create issues with pilots that never left to begin with. They want money too. So airlines are going to be hurting, let alone you got baggage handlers, ATC, air traffic controllers, flight attendants. They mothballed some planes. They took them out. It's going to take them, 60 days or 30 to 60 days to get them back up and running. And the people that certify them, a lot of them were laid off. So you've got this daisy chain. That's just the airline industry. It's happening across many industries, guys. So you just cannot, as I said, shut down the economy, turn it back on, and expect things to be up and running like a light switch. That was one of the biggest mistakes I think the planet made. We went down this rabbit hole and we went deeper and deeper by these idiots like Fauci and others. They just became emperor supreme, controlling the economies globally. And we're now going to experience the taste of that. So that's what I see happening. Now, what I want to do is switch you over to the charts. I've got a couple of charts I want to show you here. Like I said, it's going to be a shorter than normal roundup for the weekend because I basically want to go to the beach and chill out and have a cold beer. So I'm going to show you a couple of charts you need to get set up on your screen. And I go this with them. Our members know this and they go through it. And many of our members follow these charts, but the ones that don't do so in their own peril. Now, I do know that everybody's got their own set of charts to follow and their own way to do this. But what we've done and how we do it, we manage to make money even in very ugly, bad markets. And we're not trying to guess where price action is going to go. We just let the charts tell us. And then we honor the charts. And then you're never going to be right 100% of the time, but you will have the edge of over 60 to 65% of the time. And that's all we need. From the option perspective, with our Option Masters course, I show our members how to look at skew and volatility, because if you're playing the options world, if you don't understand skew and volatility, then it's a 50-50 bet whether you're going to make money in options or not. If you understand it, again, you got that edge and you can do fairly well, as we're doing right now. Okay. Again, it's the red stripe zebra approach. Most people do not know how to trade options. And they don't know when to add, when to take away, how to roll, how to manage the market option position or based on the market regime. Okay. So we're now in a new territory. One of the things that I want to show you here in this market regime is let me just get one other thing on the screen here, and I want to just switch back real quick, and then we'll jump over to the charts. I actually skipped one thing here, so let me just get us back over here. Take a couple of seconds to come up on the screen. But the markets tend to move in large wave cycles, okay? And that's just the way the markets move. And you could have a cyclical bear market, meaning it's not going to last very long, and a secular bull market. If you look on this screen here, these are all the uh, market performance going back to the 1920s, okay? And it comes all the way up to Friday's close in the 2020s. So there, it's broken out in decades, okay? Now that doesn't mean each cycle automatically starts and stops at the beginning and end of a decade, but it's very close to give you an idea of the performance, okay? And you can see in there we had the most bear markets in a decade were in the 30s. And you could see we actually finished the decade down almost 40%. Even though we had the Great Depression in 1929, by the time it caught up with the markets, it was in the 30s where the markets really suffered. And then you can see we had, and it continued to suffer in the 40s with World War II, and then coming out of it in the 50s, 60s, and 70s. Especially the 50s was more governed by the World War and all the manufacturing that came out of the war, World War II. And then you got the 60s, and in the 70s, we suffered with another bout of very high inflation. Interest rates got up over 18%. We had two bear markets, but essentially for the decade of the 70s, the markets were flat, okay? 1980s and 90s, the 90s were kind of really strong performance. One of the best. We'd had no bear markets in the 90s. That's the only period outside of the 2010 period just recently where we didn't have a bear market. All right. If you look at the 2000s, it included two bear markets. We had the dot-com bubble and we had 07 and 08, 2007, 2008. And then coming into the 2010s to 2020, all that stimulus money came in and it floated the market. So we pretty much had our bear experience from 2000 to 2010. And then all the money, trillions and trillions of dollars that got pumped into the market, our balance sheet expanded by over 4 trillion, all that money into the markets in the 2010 to 2020. We probably would have performed a lot worse, but that's where we were. And the average annual return was over 17% each year in the 2010, right? Now we're into the 2020s, and we've already had one bear market with COVID and actually in March of 2020. And now we're moving through right now. You can see the number below the average bear market length. The first number is months, and the second number is years. So you can see the average month and average year, and then look on the far right and get the average for every bear market, okay? And then the decade average performance below. So you can see the total bear markets were 26. The average moved lower. For each bear market was a little over 35%. Now we're down about 19.8% right now if we add Friday's close in. So if we do get into a longer term bear market, it could be a cyclical bear market, then we've still got more downside that we could see. But I just wanted to show you that having a bear market is normal for the markets. And if you look at decade performance, we're now in the 2020. So 2020 to 2030, I think we're going to see a lot different regime. In the 2010s, it was money coming into the economy, very low interest rates, balance sheets plump, SPACs, IPOs, all of these things were just pouring into the market. Well, now the 2020 regime, we're going to see higher inflation, higher interest rates, higher volatility spikes. We're going to see lower asset valuations. I think we're going to see societal changes, inequality kind of things, politics, populism, progressivism, whatever you want to call it. We're going to see geopolitics jump up a lot more. I mean, it kicked off with Russia and Ukraine, but I think we're going to see more over the next 8 or 9 years, rounding out the 2020 decade. We're going to see environmental issues with the green, not go green. They're already fighting and duking it out in Europe with energy being zapped away. Germany's already starting to fire up coal plants. We're going to see those kind of things change. We're going to see this whole deglobalization kind of change with the economy. Demographics are going to be changing. You're going to see a lot more inflation, so you're going to see cash favored. Cash is going to be more in favor, commodities, real assets, these kind of things. It's just the whole regime for the 2020s are going to change. And if you don't understand, you can't trade it like you did in 2010 to 2020. You're just not going to do it. If you do the same thing that you did in the 2010s, that decade, you're going to lose money. Okay. So for our members, I'll keep everybody on the right side of the table and we'll be able to make money. But for those you retail traders that just don't understand it and you're just buying stock like you always did, your performance is going to be subpar, if negative. So I wanted to show this chart to you. So let me switch back over and let's go take a look at the charts here. Let's get us back over here like this. So this is going to go blank for a couple of seconds and then it's going to show you. And I'll show you a couple of charts that I like to use. I'm not going to show you all of them. Members, you understand, but you know, for the free folks this weekend, it's July the 4th, so I'm feeling nice. So let's just go into a couple of things here. So you can see we made a low, 2022 low. We were down 24.52% coming in on June 17th, and then we had a little bit of a rally here. Okay, now I think I showed this in our last weekly roundup, and I'm going to show it again. So we had a rally, but again, these bull traps are killing people. Okay, they're killing them. You can see on this rally here when we made a lower low, we didn't make a higher or lower low. We were almost flat in the MACD. That suggests any move up is going to be sold off, and that's kind of what we're getting right now. Okay, you may know that I've already reduced my downside support area. It was 38 to 3,700 in the S&P. I've lowered it down to 35 to 3,400. Okay. For our members, I wanted to detail on why and how I did that and the logic behind it. Right now, this is a bear chart. The 50's below the 200 EMA, and that's really all you need to pay attention to at a macro level. Okay. Any rally here is probably going to run out of steam at the 50 EMA. If you get forward momentum and you have follow through, then the next area where the possibility of running out of steam is the 200 EMA. Now that the 50's below the 200, you can see right here, we sat here a little over a week and a half and we just could not get up above, and that just heightened the risk of a down move. Okay. So this is just one way of looking at this. Another way that I've shown you guys is using the Andrews pitchfork, which shows you kind of a secular view. Not a cyclical view, but a secular view. And we're on a weekly chart. And you could see the low pivot here back on December 2018. Okay. On this weekly chart, it kind of creates just a general uptrend on the this blue line here. And you could see we came right down and hit it. And you see I've got some thin bars and some thick bars on the screen, both using Fibonacci key pivot points going back to 2018. And the thick bars are basically a extension off the lows that we made in COVID. The thin bars are a retracement we made off the highs back in January 4th when we hit our highs. Okay, so you can see where these lines almost intersect. They tend to be very strong resistance and our support points. Let alone, you can see where we came down and almost to the penny, hit our Andrews pitchfork line off these key pivots back here. And now we're sitting at this level right here. So this is a chart you need to understand and just put on the screen and keep everything off of it. And then just look at it from this perspective. It'll give you a longer term view of where should I expect support and or resistance on the chart. Okay. And then another one that I like, and I believe you can, I don't know if you can do it in Thinkorswim, but on my screen, I've got here, let me just put it on like this. You can see I've got point and figure, and the white number shows the number of, the small white letter number shows the number of days that it is bullish or bearish. If it's green, that means buyers are in control. If it's red, that means sellers are in control, right? And if you look at it, you can see here that sellers moved back into control over the past couple of days. Buyers were in control for 5 days here. Sellers have been in control for 2 days here. Okay. And then you can see the count. The big number, the big font number just represents a month because you can have 2 or 3 months on one row. I'm not going to go into how to interpret point and figure and what the numbers mean, but essentially right now we're seeing sellers in control. Now, another chart I also like, and I show this to our members. I'm going to show it to you guys here. This is something easily that you can put in Thinkorswim. And let me just show this comment up here. Since the beginning of the year, we've had 7 bull trap rallies. The average move higher on the bull trap was about 7.7%, roughly 7.69. The average number of days on the bull trap was 6. Average point move 312 points. Now this is all in the S&P. Okay, so if you move up in the S&P over 300 points, be very careful in this market. This is classic bear market traps where we'll throw a big rebound and then all of a sudden everybody on TV, including Kramer and others, get sucked in and go, well, now's the time to load up on stock. You need follow through to make sure that that's what you're actually seeing versus a bull trap. And as you can see, I've highlighted every bull trap where we climbed up more than 3.5%, right? And every single one of them. Here's a 330-point move, 320-point move, 500-point move, and we roll back over. 153-point move here, over 3.5%. 244-point move, we roll down. Here's one, 244 points, and we roll back down. Here's one right here, about a little over 391 points, and we roll right back down. Now we're in the midst of a move here. We moved up 278 points. We're kind of sitting here. It hadn't really finished yet. I would call it finished if we make a new low. And here's our lows for the year, 36.39 on the E-mini futures. Now notice what I have on the screen is a Donchian channel, okay? That measures the 20-day look back high and the 20-day look back low. And then I plot the center of it. It's automatic on most charting systems. Just put Donchian channel, it'll automatically plot the midpoint and then the high and the low. And typically when you hit a low, you'll come up to the midpoint and run into resistance. That's a 50% fib tracement off the low over a 20-day period, which is roughly a trading month. And if you look at this like clockwork, we came in, we could not get over the 50% move. We came right up here and we spent 3 days there. Intraday we went over, but there was no follow through, and we're coming right back down again, okay? The total move from low to high is 563 points in the Donchian channel. So this dashed line, you don't even have to put your Fibonacci extensions off the lows, but it just gives you a general idea. Now, why are Fibonacci retracements important? That tends to be human nature involved, where human nature and just trader mindset, especially retail traders, tend to take profits and or losses. They tend to buy or sell around these fib nodes. So it doesn't really matter why they work, but it is human psychology. But the fact is they do work, and it gives you an edge in the market. So using this form of charting, right, and then combine it with a couple of other indicators gives us a little bit of an edge in the market on just knowing where the markets are going to move. So these are the key areas and the key charts that I like to use, right? There are others that we use, but these are really important to us as far as trying to get an edge in the market. So that's a little bit about where we're sitting here, okay, in the S&P E-minis. Now, I'm not going to spend time going through NASDAQ, the Russell, the Dow, but you get the idea. They're very similar in nature. Volatility the same way. I'm not going to spend time on that. We will take a look at the bond market real quick. You can see the bond market. We got short the bond market in November of last year, right over here, when we're running into trouble. And then you can see here, let me just get the 200 along with the 50 lined up. You can see the 200, the 50 EMA crossed over and is below the 200 EMA, and it's been like that for quite some time. All right, we got over here in this level here back in 2020. The 50 went below the 200, so it has been a bear market chart going back to Q4 of 2020 for the bond market. I got all our members short the bonds right in this area right here, right around October, November of 2021. And we've just ridden this thing all the way down. You can see on a bear chart, and I call it a bear chart when the 50 is below the 200 on a daily chart. You can see we had a little bit of follow through here, but when you follow through on the 50, the next resistance point is the 200. We fell right through that. We could not break it. And the minute we broke the 50, did a retest and started coming down, that was another measure here of we're going to get uglier in the bond market, which means interest rates are going to go higher. Now, I'm telling our members, do not short the bond market. Bonds are probably going to end up higher from where we were at the lows of 2022, which means interest rates are going to come down. And you may say, why the hell are interest rates coming down when the Feds, as I said earlier, one of the certainties I have is they're going to be raising the rates. Well, because the rates are always forward looking. And even though the Feds are going to be raising the rates, remember their Fed fund target, right, or rate right now is 1.5 to 1.75. They're going to take it up a lot more, okay? And by doing that, but the 10-year and the 30-year are coming down, basically is the bond market, the treasury market, telegraphing that we're going to slow down global growth and more specifically U.S. growth, okay? So that's why the interest rates on the 10-year and the 30-year are coming down. And a lot of retail traders don't understand that, and they just get confused and say the markets are rigged, but they're not. Markets are very logical in their thinking. Over a week or 2 week, they can be illogical because that's the human nature of the overreaction to the upside or downside in any price move. But over a 90-day period, they tend to work themselves out. So for longer term, we've got these ways to trade the markets that really work out nicely. Shorter term, we have other tools that we use, especially for the options traders, using volatility and skew to have it on our side. Okay, so this is the bond market moving up, and obviously because the bond market's moving up, if we look at the 10-year interest rates, well, guess what? They're coming down, and they're probably going to come down to this area down right here around 2.5%. And this is a vote of non-confidence on the go-forward U.S. economic growth. That's all it is. I had forecasted they wouldn't get much higher than 3.31%. If you guys, that follow me on the weekly roundups, but we just blew right through it. Couldn't hold it when we found support. Blew through it to the downside, tested it, and that was it. We'd given it all up. So that's kind of where I see we're going to be going. And then, of course, if we look at the U.S. dollar, eventually the dollar is going to come cratering down. 50 EMA right now is holding the dollar up. We could make some new highs. Remember, the dollar does not travel on its own. It's called the dollar index. It's indexed to the euro, yen, pound, Canadian dollar, Swedish krona, and the Swiss franc, right? So right now, though, you don't need to follow the Canadian dollar, the krona from Switzerland and Sweden, the franc. You don't need to follow those. Just follow the euro, yen, and pound. The euro is about almost 58% of the dollar index. The yen is almost 14%, and the British pound is almost 12%. So wherever those go, this goes in the opposite direction. So if the euro, and the easier way to do it is just look at the euro. If the euro is going up, you got a 90% chance, 85% chance that the dollar is going to go down, okay? And right now the dollar is moving higher, which means I promise you when I come over to the euro and we take a look at it, it's going down. If the euro jumps into a recession and the Feds are continuing to raise the rates, we're going to come down. My target for the euro is down around 102 to the dollar. That means the dollar is probably going to make new highs. If we get down in this area down here, I will look at probably going long the euro. I've held off here. Notice it could not get over the 50 EMA. Again, the 50 EMA is below the 200 EMA, so it's a bear chart. And the first challenge is always the 50 EMA on a bear chart. And notice here, it could not, we spent almost 3 weeks here, could not get over it. Came back down, went up, challenged it again, could not get over it. So that probably means the odds favor the euro going lower and the dollar going higher. Okay. And then, of course, if we swing over here and look at gold, I have said gold is probably going to go lower. You can see here, we've now gotten across in the 50 and the 200. My target for gold is around 1760. and we're just moving down towards that range. Okay, and that means gold is going to catch up to silver because silver is also ugly. And we're probably, if we look at silver, you can say we see that we made new lows in silver right here, right? My original target for silver was right in this area here. I said if we come blowing through it, the next pivot point or price point will be 1892, and then I'm going to start looking at silver for the upside, but not right now. I think gold's still got a little bit more ways to go to the downside. Energy, also, we've got ways to trade energy, oil futures, and gold that are positive for us. I think oil is going to stay bid. It's just going to be very choppy with a wide range. All right. And we've got a way to trade it in the options world. In the oil futures market, using futures options on oil is a good way to trade it. Now, we've also we've traded a pair trade where we trade Brent against West Texas Intermediate, WTI. We haven't done that in a year or two. I haven't seen a really good setup in that yet. But trading oil futures, trading options on oil futures is a better way to go because you've got a defined risk trade in the markets, and that's what I like. Nat gas, we're also, but net we're long oil and we're long natural gas. You can see natural gas just came cratering down. I think it's going to find us. My area of support for nat gas was around the 4.5, 4.6 area, right in this shaded zone here. I think it'll be elevated for a while. And once they get that LNG terminal open again on the Gulf Coast and they start shipping more nat gas, LNG over to Europe, then you're going to see nat gas find a bottom here and start moving up a little bit. All right, everybody, that's kind of where we're sitting. Members, have a great 4th of July weekend. Everybody else, enjoy the 4th July weekend. Monday is a closed day. Markets will be closed in the U.S. Short holiday week next week. I will be traveling for 4 or 5 days next week, so I will see you guys the following weekend. All right, everybody, have a really great one. Everybody, enjoy the beer, enjoy family, enjoy the holiday weekend. Ciao, everybody.